Welcome to the daily update, where I'll go over the action in the market for Thursday, August 14th, and we'll see how things look for Friday, August 15th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, didn't really see any follow through in Thursday's session. We still had an up day, so ever so slightly, we set a new all-time high with the S&P. We did not set one with the NASDAQ and NASDAQ 100. They actually declined. We saw mid caps and small caps weaker after they had been doing better. We saw growth outperform value, at least at the mega cap level. And some of the broad participation that we saw after Wednesday, that was kind of taken away on Thursday. And all this can be pointed back to a stronger than expected PPI. It was much higher than expected. And that's got people freaking out again. And now instead of a 99.9% chance of rate cuts at 25 basis points in September, now that's dropped back because the market has to rethink things. That's why I look at those charts. I go over them in the weekly video. It's called the Fed Watch tool. And we look at and just see how they change over a period of time. And that's why we don't want to get too focused on, okay, at the October meeting, this is what they're going to do. We look at that, but realizing that there's all these variables that happen as each day passes that can change that around. And it wasn't a really strong day. We saw a little bit of buying going into the close, but not very much. And we're still dealing with overhead resistance. There's the 64-68 level that the market is still dealing with. And that's on a weekly chart. So Friday's going to be kind of pivotal to see, are we going to close above the 64-68 level? Are we going to go down below it? Until we can close above it on a weekly chart, that's still considered to be overhead resistance. And I'll show you what I'm talking about there. So at the open, we had a gap lower open. There was a negative reaction when PPI came out. We came down at S1 at 64.48, and we actually dropped a little bit below that. But then prices were able to climb above the daily pivot at 64.64 and the unchanged level. So we actually went positive there for a while. Then we declined back below. So we were a little bit into positive territory. And as I usually like to mention, the unchanged level is usually support or resistance. It's built in each day. We went a little bit above it. And then that was probably to trigger some stop losses, either to buy or to sell. Those got taken out. And then we turned around and went back down below the unchanged level and the daily pivot. We went back down to S1 again, but didn't quite drop as low as we did right at the open. And we rebounded back above the daily pivot. Very choppy day. And the unchanged level, and chopped higher to close slightly positive. So just a little bit of a blip up when we were finished in Thursday's session. We were just up 0.03%. We're still below average with volume. And we're still positive on all time frames. And our indicators are still looking okay. Not as solid, and a good update on Thursday would have helped that to really improve, but that's how these things tend to go. It's rarely black and white. There's most of it's gray most of the time. And now the market's more concerned about inflation because we're seeing we got the CPI report a few days ago, and that was market friendly. That's people buying things. Then we get the producer price index, the PPI. Well, that's really going up. And are those costs going to be passed on to the consumer and make the CPI go up? And that kind of had the markets rattled a little bit there. But there's still this buy the dip mentality happening, that anytime there's any kind of weakness, there's a lot of folks just coming in droves to buy things. And so far, that's been keeping, especially the S&P 500, it's been keeping it elevated and keeping it from really declining. And then there's a lot of geopolitical things. We've got the meeting between Putin and Trump that's happening in Alaska. just to see if anything is solved that way. There's the trade deals, the tariffs. This just continues to go on and on. All right, so some comments. We did set another new all-time high with the S&P. PPI was stronger than expected because what had been starting to form was this scenario, and some of this was coming from people that are on the FOMC themselves. And Scott Bessent, who Treasury Secretary, they're like, well, not just 25 basis points. We need a 50 basis point cut. That's 0.5%. And that's really what the administration is shooting for. They want interest rates lower. That'll help economic growth. Lower interest rates are generally considered better. The market, at least initially, tends to like that. But again, we have to realize what is the context if they do come in and cut rates. Is it just to get the economy to hum along even better, or is it because the economy is falling apart? But with the stronger than expected PPI, the arguments for a 0.5% or 50 basis point cut, it didn't help that scenario to advance. And then you had St. Louis Fed President Musalem, who is a voter, and San Francisco Fed President Daly, a non-voter, stated that the current data does not reflect the need for a 50 basis point cut, with Musalem remarking that he will go into the September meeting with an open mind. We've already seen a quote from him saying that he would do that. Well, apparently his mind might be a little bit more closed now. It's the market still pretty much expects a 25 basis point cut. Now they were hoping for a 50 basis point cut. Mega caps held up better, and some actually showed some resilience in Thursday sessions. And then we had been seeing small caps and mid caps do better. Nah, didn't have a good day on Thursday. Interest rates going up, possibility of inflation. That's a bad environment for the small caps and mid caps because they have to borrow so much and they need a strong economy for these small and mid cap companies to continue to grow. And then on a short-term basis, we still have our Williams percent, our CCI charts, the stochastics. We're still far away from the 20-period moving average and the short-term RSI. So these first three, the Williams percent, our CCI charts, and stochastics, when they're extreme positive and the backdrop is positive, we can stay this way for a while. And we kind of switch over, and instead of saying, oh, the market's overbought, we say, no, the market's showing good short-term positive momentum. Intermediate term, new addition to the list, the CMB composite, it just shot right up. And so it's extreme now. We still have the Sean trend meter, which is extreme. And then we're also far away from the 50-period moving average. No change here. I kind of went through what the Fed's dealing with at this point. The dollar was up. That could have pressured stocks from going up because the dollar going down is what has helped stocks go up over the last few months. Pretty much since the lows in April, the dollar's been going down as stocks have been going back up. Interest rates also rose to 4.29%. They had been at 4.24%. And sentiment is still positive. We ticked down a notch. Even though we had a slight up day, we're just still positive as far as sentiment, but we did go down by one there. And we're positive with the trend. Now we're switching over now and seeing a strengthening positive trend because the ADX is now crossed back above its moving average, both in the short and intermediate term. So that's good. That's positive to have that in the background. A strengthening trend, the green line above the red line, that's more healthy. And again, the bias, okay, barely. And really, this is kind of riding on the coattails of Wednesday, where that was more of a positive day. Well, even if we went up by a minuscule amount, that would set another new all-time high for the S&P. So the bias is positive. I'm still keeping the momentum positive for right now. Okay, reports that came out. PPI, way stronger than expected, up 0.9% month over month. They expected it to be up 0.2%. Last time it was unchanged. So it would seem pretty tame, and this was kind of a non-event a month ago. It's kind of a big deal when it came out this time. Then when you take out food and energy, of course, the things that you need, we were still up 0.9%, and they thought it was going to be up 0.2%, where last time it was unchanged. Year over year, this is now picking up. A month ago, this annualized out to 2.4%. Now it's up to 3.3%. That's got the market spooked a bit. When you take out the food and energy, also it was at 2.6%. Now it's climbed to 3.7%. And that's going in the wrong direction. The Fed wants it to go down, and most people want it to go down, and now it's actually going back up. Jobless claims, pretty much as expected, a little bit lower. They thought it would come in at 228,000. It came in at 224,000. The continuing claims, they're hanging out. They're below 2 million, but they're still in the 1.9 million range. So here are the chart of the jobless claims, where we're starting to turn up again here with the moving average, but we did decline from the previous week. But you can see here, we've been range bound, and we're kind of in the mid to even, you could say, lower end of this recent range that this has been in. So this is not posing really any problem. This is what's causing a bit of concern. We were range bound with the continuing claims, and then as we worked our way through the spring and summer, this went to a higher level, and it's just kind of staying up at this higher level. Put it together, the red line, these are the initial claims, here's the continuing claims, and then the latest unemployment rate, which was at 4.2%. Kind of to put everything on one chart. So then we look at PPI, the total, the blue line, that's going up on a year-over-year basis, and the core is going up, and that's considered to be inflationary. And goods and services, these are also continuing to go up on a year-over-year basis. Intermediate goods, year over year, processed, still kind of flattening out, but still going up. Unprocessed goods have also flattened out after they had been rising. Then here's the chart that I look at. We go with a 12-month rate of change. It's continuing to go up here with PPI. Actually declined a little bit on the month over month when we measure it this way. And then the core, this is the inflation component here, going up here on the annual basis, still having a tendency to decline on the month over month basis. And here's another way of looking at this. It says the headline and core PPI each surged by 0.9% month over month. The most, blah, blah, blah. Services rose 1.1%, driven by margins, while goods prices increased by 0.7%. And so this is producing some inflationary concerns back into this. And you can see the accompanying charts here where they show the increase. And to further contextualize, this was over an 8 standard deviation surprise. If you deal with standard deviations, I have a standard deviations chart where I just go 1, 2, and 3, and we get concerned when we're in the +3 or -3 channel. This was in an 8, so it really deviated away by surprising the market. And the futures immediately reacted, but as we've been seeing, the buy the dippers are out there, and anytime they see some weakness, they come in and they start buying, and that's helping keep the market propped up for now. All right, and then we look at the ISM composite, and there's a lot of different ways to look at this. I showed another proprietary form of this economic report, and where that one's looking okay, but we're seeing a lot of choppiness here when we look at the equally weighted 70-30 here between, I believe it's stocks and bonds, and then how they actually calculate this. But we're not really seeing an awful lot of conviction. We were coming down, and now we've been going a little bit up, a little bit down, a little bit up, a little bit down. And then here, this is more positive. It says, yes, the Fed has cut rates near all-time highs, and the bulls loved it. This just shows at the bottom where we tend to see good returns, either 6 months or 12 months out. They're not quite as robust the next month or even 3 months later. Actually, they do a little bit better 3 months later. But this is seen as, once you set a new all-time high, it makes it easier to set another all-time high, and that's usually when things are going well. Okay, then we get our usual chart that shows us the market's overvalued, something we've been talking about for quite a while. We look at the 22.8, that's the PE ratio here for the US, and then how it's overvalued compared to the rest of the world. Equity futures and positioning here, we're starting to get above this dashed line, which might mean we're getting a little bit extreme there. Healthcare. Now, there's some folks that are probably having the attitude that, healthcare is really underperforming the S&P, and it's really been doing bad even when you look at it by yourself. By itself, when you just look at the healthcare sector, and I'll go over that in the intermarket analysis video over the weekend. maybe it's time to do some bargain hunting. And so we've been seeing a little bit of money coming back in there because the companies, for the most part, are still strong and they were starting to really come up and now dropping back down a little bit. Then we forecast year over year core CPI inflation at 3.3%. Okay, good for them. All right, so this is just breaking out the different areas. I usually don't go this deep into this. We look at the headline number and the core number and then see how the market reacts to that. But these are all the different areas that are used in either the core CPI or the headline CPI. Then sector that have announced buyback, a lot of buybacks right now with the financials. Now the financials continue to underperform the S&P, and that's been a concern. I've been saying it day after day after day, but we're also seeing a lot of companies in the financial sector announcing that they're going to buy back some of their own stock, and that could actually help that sector to do better. Small cap positioning, folks starting to get back into it, but didn't have a good day on Thursday. And then we look at the Mag 7 valuation here, and it's a little bit hard to see because I had to make this big chart a little bit smaller. Among the Magnificent Seven, the only top 10 most expensive stocks in the S&P is Tesla. But on the other hand, look at net income. I think these stocks still have room for multiple expansion, actually. Okay, so yeah, looking quite expensive here with Tesla at 136 PE ratio. You average all that together, it's 27. That's still very high in and of itself. And then down here, you're looking at their income, and Tesla is not great, but it's not terrible either. And this justifies stock prices going up. It's like, okay, yeah, these stocks are already expensive, but look at their earnings going forward. We can still justify stock prices even going up from here. Then the misery index, isn't that a happy thing? This is not a trading model, and there's no suggestion of a crash, but this relationship between misery, this is when people are not very happy about things. And we'll get another read on this in Friday's session with consumer sentiment. And equity market, whether it's cheap or rich, identifies trends, and the coming trend is cheaper equity. That would mean the market goes down to the economy relative to the 10-year yield. Okay, so we're seeing a bit of a divergence here and that usually doesn't last for very long. And so this could mean that stocks might end up, this is suggesting that stocks could decline. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. All right, here is the chart. We did have a lower open down around S1. Fortunately, though, on the positive side, we set the low right at the open, and we got back above S1. We tried to go positive here. Here's where the buy the dippers are coming in. We're filling the gap. Notice how we did not get above Wednesday's high here, and we're dealing with that 64.68 level. In fact, that's where we closed in Thursday's session. So do you think the market notices this long-term pivot point that we've been talking about? And then we came back down to S1, and we tried to go back and go positive, and we came back, but not quite as much, and we went back up and closed slightly positive on the day. So, and up a little bit in the initial overnight session, and this is where things really dropped off. Things were looking okay, but kind of quiet, and then the PPI report came out. We dropped, but then we spent the rest of the day coming back after that, and that's considered positive there. We're still seeing the red line above the blue line. They both having a tendency to go up here, and so that's looking okay. It's holding up. We would like the blue line above the red line, but the fact that they're still advancing is positive. And now I added some moving averages here because I'd say look at the bigger picture here. Well, I have a really short-term trend, a 20, and then a 50 and a 200 here. Now this is an intraday chart, but this is just to give us an idea of what is the overall trend. When the red line is above the blue line and it's above the green line, that's positive, and that's better for the market. Well, you can see how we're starting to drop down here because we had been outperforming, and this was still looking really healthy. Now it appears for the time being that we've topped out, and now this is starting to go down overall, and that could be some weakness that is coming into the market. So, but growth was up in Thursday's session where value was down. But when then you switch over and look at the mid caps, growth was down more. It was also down more for the small caps. So we're seeing a dropping off here of our small cap growth to value ratio. It's been pretty much going sideways after it did establish an uptrend. And you can see we had nice days with the small caps, and now here's what we've been seeing over the last few years. Couple of good days, and then we start to give that back. We don't know if that's going to continue, but that's the pattern that we've seen over and over. Very similar story here. Mid caps had a good day and then gave that back. We're actually dropping below the 50-day moving average with the growth to value ratio for the mid caps, coming down to the 50-day moving average here with S&P. So we're seeing it on the intraday charts, and now we're starting to see it playing out here. Hasn't turned negative yet. We just want to continue to watch this to see if there's more weakness. And the cat says hello if you hear him in the background. But we're still looking okay. Now, if we can bounce up off of this, naturally that would be more positive. And after setting an all-time high here, we did pull back in Wednesday's session. Now we ticked up a little bit with this growth to value ratio. And we did see some improvement with the discretionary to staples ratio. After it had been chopping sideways and drifting lower, now we saw a nice little up move, and we were able to hold on to most of those gains, even with the slight downtick on Thursday. So our trend, now we're above the moving average. We're positive with the green line above the red line, and we're above 20. So this is a positive, strengthening short-term trend. Also, above the moving average, green line above the red line, above 20, a positive intermediate term strengthening trend. And still below average with volume here. We actually dropped back down after we have spent pretty much the whole week below average with volume. And did tick up a little bit on a closing basis with the VIX, but we're still below 20. The overall tendency is for this to be declining, both with the line chart and the bar chart. This is showing the same thing, but this was at the Isabel Net blog charts, just showing how the VIX has been declining. Now, we're not in the 14 range now. See if I can pick that out. These numbers are hard to read. We're back at 17. No, we're at 14 now. So we were at the lower or mid part of 14s. Now we're getting to the higher end of the 14s. And that's pretty low. That's just showing that there's not a lot of fear in the market. But this is what we typically see this time of year. We're just not seeing it yet. We typically see some kind of a decline. We're not seeing that yet. I started talking about this in the middle of July. Nothing materialized in July, and now we're getting to the middle of August, and nothing is still materialized to this point. But it doesn't mean it won't happen. It just hasn't started to come to fruition, at least yet. And we did pick up a little bit above the moving averages with the VIX of the VIX. And we're still up in the red area with the skew index. The market is still expecting some kind of a big move. We ticked up with this fear gauge. We also ticked up a little bit with this other fear gauge. So there's a little bit of fear coming back into the market. Then every week we get the individual investor survey. They're dropping down. They're even a little bit more negative here. So they're a little bit more pessimistic. We saw a nice little move up here with the equity put call ratio. The Thursday with the PPI, that kind of caught folks off guard. And now we're seeing an increase, at least on the daily chart, of hedging. This means more puts were bought than calls. And we're going back up with the 5-day chart, but we're still going down with the 10-day chart. So I'm not seeing some confirmation there. We continue to come down. Now we're in the band with the volatility risk premium. So this seems to be working its way off and actually getting lower. And we tick down after setting an all-time high here with the advanced decline line based on price. We didn't set the high based on volume. And that's one thing I was pointing out yesterday is in some of these areas, we're seeing price leading volume. It's usually more happy, more positive. And now that can work to the downside too. But in this case, to the upside, it's better when volume is leading price. You see volume go up and set new highs or really showing strength, and then price tends to follow that. We didn't see that in Wednesday's session. And so we didn't set a new high here based on volume, but still in the bigger picture, these are positive. And we declined, but we're still above zero with the advanced decline ratio charts for the short and intermediate term, still above the zero level, even though we were flat with the 10-day advanced decline oscillator. And we are improving here, and it's not so much that we're seeing a real breakout of new highs. They're healthy, and we're seeing a lot more green, but we're really not seeing any red. right now. And so that's turning the 5-day chart up and the 10-day chart up. Still positive here with accumulation distribution. We're above the advancing moving average. We did roll over a little bit, but we're still above the moving average with the boom indicator. And we're still flat. We were flat after Wednesday. We're still flat after Thursday here with the Chaikin money flow, but it's still above zero. So you could treat that as positive. You could actually treat that as negative. We're still positive though with the Chaikin oscillator. It's above zero, above the moving average, and continues to advance. Still positive, but not really showing an awful lot of conviction here in August with the vortex indicator. And after we had been improving with the S&P to NYSE study, we saw a little drop off here where the S&P held up better than the NYSE advanced decline line. But we're still positive, even though we pulled back with all the different advanced decline lines here, we're still above advancing moving averages. And we did decline, but we're still above 50 with those stocks in the S&P above their 20-day moving average. We ticked down a little bit with the 50-period moving average study, 100 moving average study, and 200. But all of these are considered positive since they're above 50. So here is the pivot point. Now, this is a daily chart. I'll get to the weekly chart here in a little bit, but we're still holding up above this pivot point now. And so we're above that. That's positive, and we are still in an uptrend, but we are back below, even further below average with volume than we were earlier in the week. We ticked down a little bit, but we're still above 50 with the 20, 50, and 200 period moving averages on the S&P. Not seeing an extreme reading here, but it's still positive. We're above the midpoint with the Stochk RSI, even though we're leveling out here. But we are extreme with the Williams percent R, the CCI 14, and 20. And the force index, still above the midpoint, even though it did decline. It's still positive. Stochastics, we're still extreme in the short term, still going up in the intermediate short term, also still advancing with the long short term stochastic. The 20 period moving average, that's the short term trend. It's continuing to look good. The blue line and the green line continue to go up. And we were in the +3 channel. This is the other standard deviation chart that I referred to earlier, where they're in the 9. We just came out of the 3 here. We're right on the border between +2 and +3 with the standard deviations chart. And we're still below zero here with the balance of power. And it had been choppingly improving. Is that a word? But it just can't seem to get back above zero. This is the CMB composite, where it was pretty tame and then it just kind of exploded here, and it's above the black line. So it's giving us an extreme positive reading. Still positive with the no-go, it's hard to say, go, no-go system with the darker blue bars. Still coming up to the highest high value here, so not an awful lot of damage was done, and we did have a slight up day. Now we're up to day 73 with the latest uptrend. We're, according to the Landry light system, when we get beyond 40, that's when we think it's a little bit late in the upward move, but we're almost double that. We get up to 80. We're still positive with the proper order. Now we're seeing some improvement finally here with the TTM squeeze. It's starting to go up as the S&P has been going up. And standard deviation, we've been moving kind of swiftly, not on Thursday, but you take the last number of days together, this calculates the last 10 days, and it measures the speed, and we're starting to come above the moving average. And we still getting a positive reading here with the Arun, meaning that there's more buyers and sellers, even though both decreased on Thursday. Still slightly positive with the ease of movement. We came down, but we're still positive with the S&P McClellan oscillator. So we're still going up based on price and volume. And we came down, but still above zero with the NYSE McClellan oscillator. So we're going up with the summation index based on price and volume for the NYSE. And still going up, but slowing down with the Swindler Trading Oscillator. Just ticked up a little bit here based on price and volume. And came back a little bit. We were seeing some improvement with the PMOs inside the S&P above that are rising. That was looking pretty solid. It pulled back. We're still going up slightly with the buy signals, and we're seeing a little bit of improvement with the PMOs above zero. And we're starting to turn up with our momentum oscillators. We're not quite above the moving average here with the PMO. We're starting to cross the moving average based on price. We're not quite there based on volume. And this is where we're seeing price tending to lead volume a little bit. We like it better when it's the other way around. Positive with the Elder's Impulse system. positive with the parabolic SAR, going back above the moving average with the slope oscillator, and not extreme since we're below this green line. So we're seeing some improvement in the short and intermediate term. The long term, that's going to take longer. That's why they're long-term oscillators, but we're seeing some improvement there and starting to cross back above their moving averages. Improving, but not quite above the moving average with the Copic curve, and tick down a little bit, but still in this dark green area. We're extreme with the Sean trend meter, and the MACD starting to turn up a little bit here. The money flow is still above 50, even though it declined. We're above 50 and advancing with the ultimate oscillator, above the moving average with unbalanced volume, still getting an extreme reading. We're right on the border here with the Bollinger Bands. And we're still a little bit extreme with the short-term RSI. Still looking pretty solid with the intermediate term, but we're not above 70 yet. And the intermediate term trend, still seeing the red line going up and the blue line going up. And then we look at our short-term trend. We're above the green fluorescent line. That's starting to turn back up. The red or orange, whatever color you want to call it, that's going up, as is the blue line. So this is still showing the short-term trend is intact. We're also positive since we're above all the moving averages, but we're still far away from the 20-period moving average and 50-period moving average. And we're still going up, even though it declined a little bit here with the bullish percent index. We're still above the moving average, so that's still positive there. And we're going up with the NYSE bullish percent index, but we had crossed back above 50 with the NASDAQ 100 bullish percent index. Now we're crossing back below. That's turning that negative. This is the weekly chart that I've been talking about. Do you think this is an important level here? We've been dealing with this now for the last couple of trading sessions. Friday will be the determining factor whether we close at, above, or below this R1 level at 64.68. And that's just about where we closed. So we closed at 64.68.54, where I actually round this up to 68. So we're about 1 point different right now from this pivot point. So this is being noticed by the market, and so we want to keep an eye on this, especially as we get deeper into Friday's session to see, are we going to come down from there or are we going to go above it? But when we look at the trend, we're still positive here. Heikin Ashi is going up, the Kegi chart is going up, the Renko chart is going up, and the 3-line break is going up. Longer term, we tick down just a little bit. We're a little bit concerned when we're getting up to this red line with the 150 moving average steady. We tick down with the 200, but that's still looking positive. And they're both well above the midpoint here at 250. So they're still positive. And we're starting to cross above this long-term line here with the special K daily chart. And I probably will stop showing this again after this video. I usually only talk about it, but when something's happening, I actually show the chart itself. And positive on all time frames across all the different indexes. Commodities still negative in the short term. Dollar still negative across the board. And we had healthcare. Again, maybe some bargain hunting going on there. I mean, a lot of those companies are still strong, but that's a defensive area. It was nice to see the financial sector do a little bit better. And then communication was a little bit positive, and that's a growth area where all the other sectors ended up being down. With materials, which have been on a good run, they saw the most declines. And we only had one alert triggered, and that's when healthcare had a bullish MACD crossover. So that's looking a little bit more positive. Then I want to compare this to the equal weight versions of the indexes, where we have not set an all-time high with the S&P equal weight index, nor have we set it with the QQQ equal weight index, where we've been setting new highs with the S&P and the NASDAQ 100. And still right about at this pivot point here with the Dow, it ended up being down just a little bit here, but that's been holding up a little bit better after breaking above this pivot point. Still positive with the diamonds when looking at the Eller's Impulse system. And coming down to this R1 level, do you see this convergence going on here? We've got the S&P dealing with overhead resistance on the weekly side. Now we've got a daily chart here with the NASDAQ. It was virtually unchanged, but we're still positive with the NASDAQ with the Elder's Impulse system. Also dealing with this R level, it was down 0.07% with the NASDAQ 100. Still positive, though, with the Qs. When looking at the Elder's Impulse system, starting to turn positive with the momentum of the NASDAQ 100 and still above this longer-term trend line going back to 2009 with the weekly NASDAQ 100 chart. And then we had some nice days with small caps, and then they gave 1.37% back here with the S&P 600 index. Gave 1.29% back with the Russell 2000 small cap index, but we're still in an uptrend here and still positive. Didn't see enough of a decline to turn that over to neutral or even negative. The mid caps also gave back some of their recent gains here, but they're still in a recent golden cross showing an uptrend. Still positive with the Elder's Impulse system for the mid caps. The Wilshire did it set a new all-time high on Wednesday. It was down a little bit, so it's close but not there. In Thursday's session, also a bit of a pullback with the total U.S. stock ETF. Here's the financial sector coming up off of its 50-day moving average. And as I keep saying, this chart looks pretty good when you look at it alone. But it's the concern is when you compare it to the S&P, we're underneath the 200-day moving average. We just saw a death cross recently with the ratio. Now we are coming back up, and if this could come back up and cross the moving averages, that would show some more relative strength in the financial sector. FANG index, it was actually up a little bit, so it's set a new closing all-time high. Mega caps held up better. So Apple was down about 0.25%. We had Amazon up 2.86%. That helped the discretionary areas. Microsoft up a little more than 0.33%. Google was up almost 0.5%. Meta was up almost 0.25%. Nvidia was up 0.25%. See, just small little gains here. That's what really held things together. And Tesla was down over 1%, but it's still above both of its moving averages and up another 2%, getting back about to its 50-day moving average with Netflix after it had been seeing some weakness. And we did see enough of an increase here with the Dow Jones Semiconductor Index. That's now setting a new all-time high. Excuse me. Also, another new high with the SMH Semiconductor Index. Now, we saw a new high with this on Wednesday. We didn't see it with the Dow Jones Semiconductor Index. Now they're confirming each other, and we're still seeing this ratio going up, and that's positive. The semis are outperforming the tech sector. And I have to pause this to cough some more. All right, let's see how long we last until I have to pause this again. So this improvement is encouraging. It just means the semis are outperforming tech, and that's what we like in a more positive environment. And seeing a little bit more of a stronger term correlation between US and world stocks, where they're leveling out here in the longer term correlation. Oil was up. It's back up into the 63, almost 64 range now. And still in a downtrend with the dollar, trying to get back above its 50-day moving average. It was up slightly on Thursday. Still below the 4.5% level with the 10-year yield. That's when we really start to pay attention to it. You can see the real choppiness of interest rates lately. And we did decline with the 10-year based on price. So we're above the moving average with the large caps, below the moving average with the mid caps and small caps. So they saw some love there for a couple of days, and now that love seems to be going away. The love that these two sectors see, it's like a seventh grade relationship. It starts in the morning and is usually finished by lunchtime. So we're still above the moving average with the Qs to S&P, even though it pulled back slightly here. We're above the moving average again with discretionary to the S&P, and we're still above the moving average and bounce back up ever so slightly when we compare large cap growth to value. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So the outlook then for Friday, we're still dealing with earnings season, but most of the big earnings have been reported as they apply to the S&P. We're positive on all time frames. We're still seeing some of these negative divergences, but they had been improving. And we would like to see more improvement from that. And we're dealing with this overhead resistance at 64.68. We're going to get retail sales, big part of the U.S. economy there, Empire State manufacturing, industrial production and capacity utilization, and business inventories. Probably the biggest one is going to be retail sales. I say that, and then it ends up being kind of a non-event. We'll see if that offers some kind of surprises there. And then one that could weigh into things also would be the consumer sentiment report. And then we got all these geopolitical things going on with the talks between Putin and Trump. And then, of course, there's things in Israel that you're probably not even hearing about in the news right now, but they're big deals. Really big things are happening. And then the Russia-Ukraine thing. Hopefully that will, at least some kind of an agreement can be reached when they meet with each other. So we're finishing out the economic calendar for the week. This also shows the retail sales is the most important report in Friday's session. And then for August 15th, we're neutral to positive with both the Dow and NASDAQ, where we are positive going back to 2002 with the S&P 500. Now, that's taking all the last 22 years together. When you look at just post-election years, this is a weaker time. And so far, we haven't been following this seasonal pattern. Is that going to develop? It could start at any time, but we're just not seeing it play out the way it usually has. And again, August tends to be weak, but not so far. This also shows how August is weak, but not so far. August tends to be weak, but not so far. So we are back below 50 with the bullish percent index for the NASDAQ 100, and we're improving with the Zohorchak method, but it's still negative since we're getting a -6 reading there, but it had been at a -10. And then I'm keeping this on the positive side, but the Chaikin money flow you could actually consider to be negative, where accumulation distribution and the Chaikin oscillator are still positive. And our growth to value and discretionary to staples ratios, even though they're getting hit right now, they are still positive. And then the S&P and NYSE McClellan oscillators and summation indexes. They declined, but they're both still above zero. And the swing and trading oscillator barely going up, but it's still going up. Parabolic SAR is positive. We are starting to improve here with our momentum oscillators. And then the bullish percent index for the S&P and NYSE are positive. NYSE because it's above 50. The S&P, even though it declined, it's still above its moving average. Ease of movement, money flow, and ultimate oscillator are still positive, and the vortex continues to be positive as well. And now we have the momentum for the NASDAQ 100 is back to being positive. And then the financial sector still looking good, but still underperforming the S&P. It's got some damage to do to repair that. And then the long-term special K chart is now positive. Here are the pivot points for Friday's session, which are on the YouTube community tab and also posted on the website. So our conclusion, we're positive, but we're still dealing with this overhead resistance. And because that's a weekly chart, it won't be official until Friday's close, whether we're going to be above that or below it. And we are seeing now a strengthening trend in the short term, and we're seeing more positive conviction. It's not full on, but it's improving from seeing no conviction at all. And intermediate term, we're also seeing some improvement there, and we would like to see a continuation of those negative divergences starting to be dealt with. Long term, we are still positive there. Thank you. I hope you found this helpful. I hope you have a great day. I will talk to you in the next video.